training for the proactive questionnaire for the loan associate in the section called Model It, what we would call analyzing the project. So as soon as you have gone through your initial questionnaire, determined if there's a fit there, and then you've collected some documents from the client, you're going to get to a section we call Model It, which is now you're going to start doing some analyzing of the numbers. So this section is specifically, typically for owner-occupied sections, although you could do income property here too. The first thing you'll do is you want to put the entity name on the tax returns here. What entity is it? Could be multiple if you do this cumulatively with multiple deals here. We want to know if this is a tax return or a financial statement. That's important. Most people on owner-occupied transactions where you're dealing with a business in the building versus just a bunch of tenants, they want to see a tax return. Financial's okay for the interim, but they want to see tax returns historically. Put the time period here. You usually want 2 to 3 years of tax returns. And then you want to put percentage of ownership that they have, because you want to make sure to bifurcate the ownership structure if there's multiple people. The next section you want to put is their personal liquidity. Just to give an idea, in that given year, chances are you're just going to do 1 year because you're just going to have a personal financial statement on the most recent. But how much physical cash, and when we say cash, we're talking about true hard cash they can get access to. I'm not talking about securities or anything along those lines, but how much hard cash do they have? It's non-debt. The personal income section, what you're going to do here is you're going to look on the tax returns, and you're going to look for consistent, ongoing, historical income they receive through W-2 wages, that they receive through Social Security, pension, dividends, etc., that again is not directly per se coming from distributions from the company. So you want to look on their tax returns to make sure you see their personal income. Then you'll start with the net income of the business. So what is the bottom line profit and loss net income on the tax return or P&L? And then you're going to add back. So we're going to add back depreciation, which is going to be a line item on the tax return. It's a non-cash expense. We're going to add back interest. Interest is something that we consider to be a post-cash flow item, so it comes under everything. So we add back interest expense, because we're going to take it all back out here in a little bit. Add back rent, and again, that's only if they're replacing the rent. So you really need to make sure you understand that. So make sure you add back rent and get clarity from the client if you need to add back rent or not. Sometimes you might even add back a portion if they have multiple locations, and so you just need to understand that that the rent is for their, that's going to go away when they buy a new building. You subtract the cost of living. A lot of times lenders will say, okay, if you have a couple of kids, it's usually $15,000 per year. So you want to add maybe $15,000 to $20,000, $30,000 a year for cost of living. We'll talk a little bit about that. Federal and state income taxes, those can be found on the tax return to show you on the Schedule 1040 on the page 1 and page 2. It should show you how much they paid in taxes. And then you add all this up. So it sums everything here all the way from the personal income down to get a total cash available to service debt. That's a really magical number. So this is how much money they have between all the businesses they have, because you might have multiple, to service the debt, okay? So you want to obviously first talk about the business that is operating to see if it can service the debt, and then all the other businesses they might have. Personal debt service. This is where you're going to get their personal financial statement, and you're going to add all of the annual payments of loans that they have every year. And you're going to accumulate that here. Then you're going to take all the business debts that they have and take the cumulative annual payments and add them here. And then you're going to add the new debt that is going to go here. Now, in all fairness, if they have a loan that we're refinancing, you're really not going to add that into their existing business debt service if you do pro forma, because you'll be double counting. So if that's already in there and it's a refinance, you're probably just going to keep that old loan out because you'll have the new loan amount in there. And then the total debt to service. So this will sum all of these up and give you a total. And then it'll show you here, it'll subtract this minus this, the cash flow minus the debt, to tell you how much excess cash they have. Now here's the magic number we want to know down here. Debt service coverage ratio. We want it to be 1.2 to 1.25 or greater. Remember we talked about that up here in this section of cash flow. Okay, so we want to make sure that we're getting 1.2 to 1.25. That's the magical number. You'll say, well, how do I know what the payments are? You can come down here and log in the loan, the interest rate, and the amortization. That'll give you the payments. And then you can plug that number here. So it's really important, for example, if we did, 2020, 2019, 2018, you'd want to see that pretty consistent, although if you have some years that are weaker prior, that's okay as long as it's trending the right way, or the most recent year is 1.25 or higher. And again, we've gone through that calculation through this series. So that's, sort of doing tax return spreads for owner-occupied. Here's a quick little model you can use to determine if somebody's giving you some numbers over the phone of just adding, what's the net income, what's the net cash flow, adding these back in, same thing, interest, depreciation, rent one time, and then just running some quick numbers, loan amount, interest rate. Usually you're going to do a 25-year amortization for properties. You just want to be able to say, is this thing going to work? If they have net cash flow of, call it 50,000, that gives them a 1.51 DCR, so that's really good. So this is just a quick way you can run some numbers based on their profit and loss of an income property. Now here's the rent roll. The rent roll is on income properties where there's multiple tenants. You're going to take their rent roll and fill all this in. So what's the square footage of the tenant? And you put each tenant in here that they give you. The monthly rent amount that they pay. The base rent, okay, because there's different rents. There's triple net or gross or modified gross. Triple net is that the tenant pays all the expenses, insurance, CAM, common area maintenance, management fees, repairs, etc. Gross is where the landlord pays for everything, and then modified is somewhere in the middle where they both pay a little bit of each type. So you put the monthly base rent, the annual rent in there. You'll calculate the square footage, the rent per square foot, because that's going to matter. Because lenders are going to say, man, if you're paying $40 a foot in rent here, and then you're paying 20, what's the discrepancy? You want to understand what percentage of the total the tenant is. That'll make a big difference when it comes to a tenant that takes 30% or more of the space. That's considered a concentrated tenant. So you want to know more about that tenant. What is their financial status? What type of industry are they in? That will make a big difference for the lender to understand. The next we go to the CAM amount, so that's called common area maintenance. You want to know how much do they pay a certain CAM every month or every year as part of their lease. And then the beginning and the ending dates of the lease, and then any additional notes that we need to know. So you want to know the total square footage, annual rent of everything, and then the total CAM amounts. The other thing to finalize on this section, which again is called model it or analyzing, is to make sure that you confirm that 2 people have run spreads. Okay, so you and one other person have actually done the same thing, because you want to just get a second pair of eyes on this. So this just gives you an overview on running some financial models. There'll be more training on this, but this is really important that this gets filled out, because it's going to make a huge difference on your personal success as well as the client's.